Hi, I'm John Hageman from JLL. Welcome to KNN. Today I'm here with Bob Knakal, and today we're going to talk about interest rates. So Bob, we're going to talk about something today that I think is very topical given what's happened in the broader economy. We're going to talk about interest rates, what we're seeing in the market, and what's your perspective on what's been happening over the last few months.
Well, Hags, I wish I understood interest rates a lot more than I do, but as folks who sell properties, interest rates are very, very important, and I think we've seen big volatility in that market. We actually went through a period where rates were really too low for too long. It created a lot of imbalances in the market, and now that rates are at more of a, let's say, normal range historically, it's really thrown some people off. It's having tangible impacts on the marketplace. I think that if we look at where rates are today relative to where they have been historically, they're still relatively low. The 10-year this morning, we're filming, the 10-year is about 3.5%, which is down from where it was a few weeks ago. But relative to where we were from 2008 through not too long ago, that's a relatively high rate. But we have to keep in mind that the 10-year Treasury over the last 50 years has averaged about 5.4%. So we're still relatively low comparatively. And so I think that some of the folks who have said, well, I want to wait to get back into the market until interest rates fall again, I think they might be waiting a very, very long time, because I think that we're probably going to be in this interest rate environment relative to base rates for an extended period of time.
So clearly with the elevated rates, it's viewed as very expensive today. So how do you think that's going to impact the market on a go-forward basis over the next 9 months for the rest of the year?
Yeah, well, Hags, I think that what has happened is that the uncertainty in the market has made lenders very concerned. And so spreads widen very significantly. That's what we saw happen in September, basically. The Fed's been raising rates since March. In September, spreads really started to expand. So while I don't think base rates are going to change significantly over the balance of the year, I think what might happen as lenders start to feel more comfortable that market conditions are solidifying, stabilizing a little bit, those spreads should compress, and that should make borrowing a little bit more affordable for our clients.
Bob, one of the things we've seen is over the last 30 days is some significant changes on the banking front. What do you think that means for the market on a go-forward basis?
Well, I think I would want to answer that, Hags, by going to 40,000 feet, right? So we go through the pandemic, there's the shutdown, the government injects about $1.5 trillion into the economy. A lot of that money ended up in savings. So you look at some of the banks that have had issues, they've had assets that were significantly in excess of their loans. So what do they do with all that money? In an environment where interest rates were minuscule, well, your options to invest are limited. You had to invest in a way that was very cautious, but very mindful that rates could potentially go up. Some folks didn't do that, and so they got into trouble. And then when folks got concerned and started taking their money out, there wasn't enough cash, and that led to what we've seen from a number of lenders. But I think that if you look at banking, I think generally the market feels pretty confident in what's happening. There may be another failure or a few, but generally the market seems to be pretty stable. I think that the Fed, in a way, has misdiagnosed what the problem was in the economy, and these rates have just gone up so quickly, and unprecedentedly quickly, and with a big magnitude, that it has impacted a number of things, including these lenders. So I think that we're looking for a little bit more stability in the market. We're seeing a lot of capital flowing from the smaller regional banks into larger money center banks. And hopefully those money center banks will take the opportunity to lend that money out. We're hoping to see that. But I think in order for the lending community to have comfort in what's going on and to compress spreads and put money out, we need to see a little bit more certainty within the markets. And we're still in a little bit of an uncertain situation. So I think that over time, as things settle, hopefully the comfort level will increase, spreads will compress, and that'll make the market function a little bit better.